being able to confidently do calculations with loans and loan repayments is a very useful skill to have. And so what we're going to do is 2 levels of those computations for you. In this video, we're going to look at the simple approach, and that's simply going to go through the basics of how to do simple calculations on how to work out repayments, what sort of savings are available if you improve your repayments in some way, and that sort of thing. So it's going to be fairly simple. We're going to do basically 2 questions, and there's an extension question that some people might want to carry on and do themselves. I'm going to be demonstrating the core ones. As well as that, there's the loan strategist exercise, which is on the same spreadsheet, but it involves building your own graphic loan strategist model, which is a very powerful model. Because of the difficulty involved, I'm leaving that as an extension activity, but I do recommend that anybody with the time and the interest have a go at doing the loan strategist exercise, because it is really, really useful to have in your little bag of tricks as you go into your professional lives and so on. And the graphic output from it is really handy because it gives you a nice visual idea of what's going on, and it saves a lot of manual calculations as well. Let's get into this calculation now, this model. We're going to be looking at a simple credit foncia loan, and we're going to be working out some simple loan strategy calculations. We're going to be assuming that we've got a bank interest rate of 7%, a mortgage term of 25 years, and a principal of $100,000. Now that could be $1 million or $10 million. It doesn't really matter what the number is. It's more just the way that the calculations work. So $100,000 is a nice round number to start with. What we're going to do is go through and do some standard calculations, and then we're going to move into looking at the what-ifs. First of all, let's look at the monthly repayments. Monthly repayment, to do it in Excel, we're looking at the PMT function, payment function. First thing is to put in the rate. Now the rate is 7% per year, and so we need to divide that by 12. Comma, to bring us to the next parameter. Number of periods is 25, now 25 years. Again, we have to multiply that by 12. And then the present value, we're going to put it in the negative. So I'm going to put a minus sign in before B9 there. So I've just clicked on B9 to get that. Hit return. And that will give us a repayment, a monthly repayment of $706.78. I recommend that you check all of these calculations on your financial calculator. And in fact, it might even be better for you not to bother with doing it on Excel, but do it with your financial calculator, because it gives you excellent practice at using the financial functions on a financial calculator. Okay, so we've got the standard monthly repayment. Now if we look at the total repayment, that's how many dollars have the borrower repaid over 25 years. Well, that's pretty easy, because we simply take the monthly repayment, multiply that by 12 to get the number of years, multiply that by the number of years, and we've got that up in that input cell, and that means we're paying back a total of about $212,000. We can work out what the interest cost is quite simply, because the repayments are principal and interest. So we've repaid $212,000. If we take away from that the principal that we're going to eventually repay, that means that we've paid $112,000 in interest. So in this case, even with a modest interest rate of only 7%, we're still spending a little bit more in interest than we have in the actual loan. Okay, now we're going to look at the first interesting question. Okay, that's really the warm-up. The first interesting question is, what happens if I repay the loan a little bit faster, using repayments that are a little bit bigger? Now, there are a lot of ways of doing this. For instance, some people prefer to use 4 weekly payments of a quarter of the monthly repayment amount. That works out to give you a little bit more per year being repaid. People don't feel the difference. In fact, paying it off weekly, or maybe if you get paid fortnightly, you pay it off as two weekly repayments. And again, you halve the monthly, pay it off fortnightly, and you're actually repaying significantly above the standard repayment. And we can ask ourselves, how much do we actually save by doing that? Here we're going to take a different approach. we're looking at a situation where we go to the bank, we borrow the money at 7%, but here we're going to say, well, we're actually going to imagine what would happen if the interest rate was 1% higher. There are a couple of reasons for this that we'll get on to later on. Okay, if we are looking at a standard rate of 7% and we're going to imagine the interest rate's 1% higher, I'm simply going to add 0.01 to the current interest rate. That gives me 8%. That's not very interesting. I'm doing that here so that I can play with these parameters later on, these values later on, and maybe apply it to other loans. So I'm looking at a notional interest rate of 8%. I'm going to work out what would happen if the interest rate was 8%. How much would my repayment be? Well, I do exactly the same calculation as we did before. We work out the payment. Now we're going to put in the rate, which is 8%. Divide that by 12, comma. We go to the number of periods, which is the same, 25 times 12. And we have the principal, which is still $100,000. So notional repayment is $771. What this means is if we went into the bank one day and they're going to charge us 7%, we'd be paying $706. If we went into the bank the next day after maybe the RBA had put up interest rates and interest rates have gone up by 1%, the same loan would be costing us $771 per month to repay. That's about an extra, $60, $70. How much is that extra payment, the difference between 706 and 771, going to make in terms of the total cost of the loan over its life? If I commit myself to paying the loan back at 771, even though I only really have to do it at 706. Okay, I can see that I'm paying it back about $65 a month more. Work that out per week, and most of you would say, well, that's not very much. Let's look at what the term is going to be. Here we use the NPER function in Excel. We know what the rate is. The rate is the 7%. I'm going to divide that by 12. The payment is going to be, I'm going to put a minus sign to keep my conventions right, 771. The principal is the $100,000, close the brackets, and I've got 242 months. Okay, that probably doesn't mean a lot to you because we don't really know how many months 25 years is. 25 years, about 300. So we've saved about 60 months of repayment. 60 months, by the way, is about 5 years. So by paying it off a little bit faster, we've actually cut 5 years off our mortgage. A 25-year mortgage has become a 20-year mortgage with relatively little pain along the way. That's the $60 a month. Let's say about $15 a week or so. Let's do the same exercise. We'll see what the total repayments are. Same deal there. We've got the number of dollars per month times the number of repayments, which we've got there, and that calculates out $187,000 of repayments. I can look at the total interest using exactly the same approach. From the total repayment, I'm going to take off my principal. So it means I'm only now paying $87,000 worth of interest. Let's look at the savings now, very, very simply. The savings is simply what it would have cost had I paid it off at the normal rate, had my extra $15 a week to spend on myself, compared to the total interest cost in the accelerated repayment. What that means is that over the life of the loan, which is now only 20 years, I've saved myself about $25,000. Now, one way or another, $25,000 is still a fair bit of money, and I'd prefer to have it in my pocket than going off to the bank, especially since that's the net saving. That's after I've accounted for the fact that I am actually spending that $15 a week more. So that's pure saving in my pocket. And so by doing without that $15 a week, I've actually saved myself net at $25,000. So that's actually almost an enforced saving plan, which I'd imagine in 20 years' time I would really appreciate, because suddenly I'm free of the bank debt a lot earlier. I can go off and do other things with my money. Okay, so we can see this is fairly powerful because even something that's quite painless is able to save a lot of money. Okay, let's look at the second question here. Second question is, let's imagine something happens and I find myself with extra $10,000 that I didn't expect to have. Okay, and I'm thinking about, well, either spending it on or maybe upgrading something or other, the kitchen, or I'm thinking of knocking it off against my loan. What's that going to do to the cost of my loan overall? Okay, it turns out that that's very dependent on when I pay back my lump sum. Here my lump sum I'm going to assume is $10,000. For this first exercise, I'm going to say that the saving is going to happen after 20 years, and so the month of the saving is going to be 20 times 12, so it's going to be month 240. The remaining term here is going to equal the original term, which is 25 times 12, minus the month when I make my repayment. So I have still 60 months to go. Now here is an interesting little calculation that a lot of people think is a little bit peculiar, but once you understand what's going on, very, very handy. If you want to work out the principal left at a particular point in the loan, you don't look at how much you've repaid, you look at how many repayments you still have to make. So here I'm going to work out the principal at the end of year 20. Now I know at the end of year 20 I've still got 60 months to go, I know what the repayments are, and so I can work out what the present value is. I use the PV function if I've got 60 months to go. I know my interest rate is 7%, which I'm going to divide by 12. I now have 60 months to go, which is the number of periods, and I have the payment, which is the $706 that I calculated way back at the beginning. And so now I put that together, and that tells me that at the end of year 20 I have $35,693 still to pay off my $100,000 loan. You think about it, that's 20 years to pay off 2/3 of the loan. Gives you an idea of how quickly our repayment is actually happening through these things. Okay, I've already written in that I'm going to be repaying a lump sum of $10,000. Now I can ask myself, what is the principal after I've done that payment? And so I go to the bank, they say that I owe them $35,000. I take off the 10, and so that leaves me with $25,000 still to go. Okay, what's my term remaining? Well, I'm still going to be paying off at the same rate, and so now I'm going to use the NPER function to work out the number of periods still remaining, given that now I have a smaller principal. The rate is still the same, 7 divided by 12. The payment is still the $706 per month. The PV is now only 25 instead of the 35. Close brackets. And that means that I only have basically 41 months to go. Should have had 60 months, but now I've only got 41. What is the total remaining repayment? Well, again, I simply multiply the repayment amount by the number of periods. That tells me that I've got about 28,900 of repayments to go. I can compare that to the remaining payments at month 60, which I didn't bother to calculate before, but I'll do that now. That's going to be 60 times the standard repayment. And so that tells me that my saving now, I've got to be a little bit careful here, because I should have paid $42,000 back. I've actually paid back $10,000, and then I'm going to have $28,000 still outstanding. So I've got to do two subtractions, or two parts of that subtraction. So it means that I've saved myself $3,445. Now, the last part of this exercise is exactly the same activity, exactly the same mathematics that we did in part 2, exercise 2, but instead it's asking us to look at the savings if the lump sum is repaid after 2 years. I'll get you to do that in your own time if you like, as a nice little extension activity. That really brings us to the end of this. What I will tell you as a little bit of a hint is that if you pay the $10,000 in 2 years into the loan rather than 20 years into the loan, the savings is considerably more. But that little bit of exciting discovery I'll leave for you to do yourself if you have the time.